Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. As the crisis in Ukraine continues, we look to the market's reaction to these unfolding and fluid events. Economically speaking, what kind of impact can this have on commodities and the direction of monetary policy, among other things? Also, can we compare this particular event to other historic conflicts and how they impacted pre- and post-war economies? We're going to be discussing that right now with my guest, Paul Donovan, Chief Economist for UBS. Paul, it's wonderful to have you here. I know you've been quite busy for the last few days, so thank you for making some time for us. Good to see you, Paul.
Thanks very much for having me back on, Anthony.
Of course. So, Paul, let me get right to it. Obviously, this is a fluid situation, and the news is changing at a moment. It may be changing as we speak. But over the weekend, we did see that the European Union, the U.S., the UK, and other allies have stepped up the intensity of their sanctions on Russia, which includes cutting key Russian banks out of the SWIFT financial messaging system. So the question here begs, what are the overall economic implications here, not just in the U.S., but globally?
Okay, well, if we're looking at the sanctions that are being applied, focusing in on those, essentially they have two channels through which they impact sort of the wider economy, the global economy. The first is fairly obvious. If you're saying you can't sell this to Russia, then companies in Europe, in Asia, in the United States are losing a customer, losing business. And that's obviously going to be a negative. So the direct sanctions, generally around issues like technology, some defense sectors, there you've got a direct prohibition on trading. With the SWIFT payment system, this doesn't stop Russia from trading, but it makes it more complicated. It adds a layer of bureaucracy, and it adds a cost to doing international transactions, to doing international business. And I say it's a bit like having Brexit and President Trump's trade tariffs sort of combined in one sanction. Now, that's something that obviously applies to Russian companies trying to do business internationally, but of course it also affects their counterparts. It's making trade more difficult and more expensive for both sides of the trade. And so that has an implication. There is a related implication around the SWIFT prohibition, however, and that is the fact that we might well see runs on Russian banks, people desperately pulling their money out. Now, that may be because they're worried about whether they're going to be able to use their Visa cards in the future, for example. It may be because they're worried about the safety of the bank in Russia. Remember, a lot of Russians have had experience of hyperinflation and of bank runs. That makes them understandably nervous. Now, the issue here is that if you get this, then obviously the Russian economy is going to suffer. If you've got a system-wide problem with your banking system, then the whole economy is going to suffer, demand is going to weaken, you'll get a recession, possibly even worse than a recession taking place within Russia, and of course, for exporters trying to sell goods to Russia, that then becomes yet another problem that they've got to deal with. So what we're seeing here are a series of effects which really push down on Russia's ability to trade with the rest of the world. But let's get a sense of perspective here. Russia is not that important in the global economy. It's about 2% to 3% of global economic activity, depending on how you measure it. To put that in context, it's half of the importance of, say, California is to the global economy. So it's not like it's dominant, but if you're doing business with Russia, you're going to find it a lot more difficult.
Thank you, Paul. I love the way you clearly defined the impact here. But, you know, look, the truth of the matter is we can't think about Russia and not think about the impact on commodity prices. Already we're experiencing higher levels of oil, and with the amount of imports and exports between Russia, Ukraine, and the rest of the world when it comes to wheat and other food commodities, what kind of impact could that have on inflation?
Yeah, no, this is a good point. So Russia itself, in the global scheme of things, doesn't matter that much, but it does matter to the energy market, and Russia and Ukraine combined matter to wheat and corn. So what we have seen is an increase in risk premium. There has been, so far at least, no change in supply or demand for energy, and of course it's the wrong season to be talking about agricultural supplies coming out of Russia or Ukraine. That happens later in the year. So we've not been seeing direct changes in the market. What we have been seeing is an increase in the necessary risk premium. Now, if this continues in the near term, this is going to add to inflation. In the longer term, it's going to mean that the rate of decline in inflation will be less than would otherwise be the case. Inflation is still going to go down, but it'll go down more slowly. Now, how can I say inflation is going to go down when we're seeing these high oil prices, for example? Well, what we've got to remember is that inflation is about the change in price, whereas when we think about commodities, we tend to think about the level of price. So we've got a difference here. The change in the oil price actually last year was pretty big. Do you remember at one point oil prices were almost zero? And so you had a very big change in the oil price over the last year. With the new risk premium, we've got another change, but that change is not as large as last year's change was. So the contribution to inflation in the second half of this year will not be as large. But obviously, the higher the oil price, the slower the decline in inflation in the second half of this year. With agricultural commodities, that's also something which will feed through into inflation, but there it doesn't feed through quite so strongly. And that's simply because, if you or I go out and buy a loaf of bread, wheat is a tiny part of the price that we pay. Farmers do not get a lot of the consumer price for food. The consumer price of food is mainly about domestic labor costs, and agricultural commodities are a relatively small part of it. It doesn't mean that prices won't go up, but it means that the relationship is very, very far from being one-for-one.
Right. Yeah, and you can see the chart there. We've seen wheat prices kind of spike a little bit on the Chicago Board of Trade in the last couple of sessions, likely because a lot of viewers may not even realize Russia and Ukraine are third and eighth largest wheat producers in the world. So it's purely we're getting educated so much, I think, on these parts of the markets that we probably weren't paying a whole lot of attention to unless you were actually a commodity trader or someone like you, Paul, who pays attention very closely to how these prices affect everything. And speaking of inflation, we can't really forget that last week on Friday, the 25th of February in the U.S., we had personal consumption data come out, rose 6.1%. That was 3 times more than the 2% target for the U.S. Federal Reserve. So the question then comes, what does Jay Powell and the Fed have to consider here? It seems like the rhetoric from the Fed is they are still on track to start raising rates this coming March 15th and 16th. 25 basis points is what the market is pricing in, although some are saying 50. It's anybody's guess at this point. But can the Fed continue the path to raise rates? Is this Ukraine-Russia conflict going to impact their decision-making here?
So it'll certainly be a factor in any central bank's decision-making. And essentially, we are going to depend not so much on the prices, but on what happens in labor markets in response to those prices. So if we see the increase in commodity prices then leading to inflationary pay claims, which then push up prices again, in other words, what economists call a wage price spiral, if that happens, the Fed and other central banks will need to be more aggressive in their policy. Because what they will need to do is to break that wage price spiral, because once that starts, it's very dangerous for the economy, and they will need to try and push growth below trend. So if commodity prices lead to an inflationary wage price spiral, central banks like the Fed will be more aggressive than we think, and they will try and push growth below trend. Now, there is no evidence of a wage price spiral emerging at the moment. For middle-aged workers or prime-aged workers, so that's workers from 25 to 54 years old, wage growth is basically normal. It's where it was for most of the first decade of this century. There's not really an inflation evidence there. Labor share of GDP is not rising. We're not seeing evidence of a wage price spiral. If one emerges, central banks need to take action. Now, on the other hand, if we don't have the wage price spiral, but you get the spike in commodity prices coming through, then what that means is we don't have a price inflation shock, we have a growth disinflation shock. Because if you're spending more to fill up your family fleet of sports utility vehicles, then you've got less money to spend on other things in the economy. And that's going to then weigh on economic activity. I think particularly in the United States, that could be a concern because in the U.S., lower income consumers at least have generally spent the savings that they accumulated during the lockdown. In Europe, there's still a cushion of savings available, but for lower income households in the States, that money is gone. And so therefore, there's a bit of a budget constraint. You've got a certain amount of money to spend each month, and more of it is going on gasoline. Well, less and less is available to buy other goods. In that situation, I think the Fed is certainly not going to follow some of the more extreme and more outlandish forecasts that the market has been coming up with. It's going to be a lot more measured in terms of its approach.
Thank you, Paul.
There's one final issue around central bank policy, which is, of course, not only do we have the monetary policy, the interest rate story from the Fed and other central banks, we've also got the provision of liquidity, the provision of cash. Now, in a situation where the Russian banking system is certainly not in good health, where there is risk aversion, some people will rush to cash. And if we see an increase in demand for cash, central banks may have to question the pace with which they scale back quantitative policy. Most central banks are scaling back quantitative policy. Liquidity that was needed during the pandemic has not been needed so much as we've emerged from the pandemic, but we may be creating now a new source of liquidity demand coming out of safe haven concerns and perhaps bank runs in Russia.
Terrific. Thank you, Paul. And just as a reminder, Fed Chair Jay Powell will be testifying to Congress here in the U.S. this coming week. So we will all be looking to see if there are any clues or any tea leaves that he leaves around to indicate what the Fed might be thinking. But yes, it seems like he is on track to continue his the monetary policy thinking. So let me ask you, before we wrap up here, Paul, clearly history can teach us a lot, but is there anything that we can be taught about the impact of this conflict that maybe we've seen in other similar conflicts, like in the past 100 years in modern times or so?
Well, I'm going to start with a caveat that this is the first European war with a Twitter handle. Social media has, I think, changed quite a lot here. It's changed perceptions. It brings war a lot closer to people, so that has an impact on things like confidence. It also has a clear impact on policy and on politics. I think a lot of the really quite dramatic political changes that we've seen across Europe, for example, are driven by popular opinion that is in turn driven by the intimacy that social media brings to an occasion like this. So that does mean we've got to be a little bit careful with some of the historical analogies. But there are episodes in history that we can look to for guidance. So, for example, Iran was excluded from the SWIFT payment system, not quite as dramatically as Russia has been, but it was excluded between 2012 and 2016. And we know that Iranian trade volumes dropped about 30% as a result of that exclusion. So that gives us a reference point to the sort of damage we can expect to see to trade with Russia, for example. What happens if Russia cuts off energy, cuts off the gas and the oil to Europe? Well, a lot of people, I think, would take that very negatively. But as someone who was actually in Japan during the Fukushima crisis, I'm not so negative because I believe that people adapt in the face of adversity. And so were you to see a cutting off of oil and gas from Russia, Europe certainly would suffer, but it would also adapt and find ways to working around the situation, turning down thermostats, working from home, engaging in energy efficiency. So I think there are parallels that we can look to historically to try and understand what is going to be happening in all of this situation. But the fact that this is a war being conducted, through the camera lens of smartphones, as it were, does change, I think, the strength, the force of a lot of the reactions. And that is something that we're going to have to continue to bear in mind.
Thank you, Paul. It's such a great point. Watching over the weekend, Ukrainian President Volodymyr Zelensky on the front lines with his army and citizens fighting against him, alongside him, and posting things to social media. It's a true game changer, and it really does, as you said, put us all on the front lines in a way that has really never been done before. Paul, thank you. It's always wonderful and incredible to get your insights, and we appreciate you so much joining us. Thanks for being here, Paul.
Thanks so much, Anthony.
Good. And we'll see you soon. And for more information, there's a lot of content that you can find by visiting our website at ubs.com/views. And make sure to follow us on social media. Lots more content can be found on LinkedIn, Facebook, Instagram, and Twitter. Plus, you can check out our past UBS Trending episodes on demand on our website, ubs.com/studios, and on the UBS YouTube channel. And as always, if you do have any questions about your portfolio, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.